Last meeting, I didn't get a chance to go over market timing, so I decided to create this quick video and go over a little bit of market timing. We're going to be using Gann's method, which is the squaring price with time. So in other words, it's basically finding the date that the event happened, the low or the high, and then adding whatever the price is, and then that tells you exactly when the next change in trend or the trend will end, and it's giving you the exact date. The second method is basically doing it, but now we're going to use weeklies. So what you need is basically a Julian calendar. Julian calendar that basically gives you the date, like January 20th. So we know January 20th is the 20th day of the year. And then let's just say the price was 22. So you add 22 to 20, gives you 42. Now you try to find 42. So 42, February 11th, is the 42nd day of the year. And that's when the change in trend should happen. So here's a quick way of doing this. We're using stock charts. As you can see, stockcharts.com. And basically, I went out 1 year, 2 months, um, open, high, low, close charts, and no indicators, 0 indicators. And also put price labels to make it easier for us to find our way. So number one, we go down here, we see 3186, and that's the first example I gave. It's January 20th, 2186, so I'm just going to round that up to 22. So 22 plus 20, 42. 42nd day is February 11th. And then, so here we go, here's February 11th, and you notice it had this drop right here, stopped in, so the end of the trend going down, stopped here, and then reversed. Now, the next one is March 7th. So let's go here, next up here, so we can do March 7th. So we did a low, now we're going to just do a high. Here's March 7th, we got 29.97. As you notice, if you went back here, you can say it was a new 20-day high or a new high. And I'll show you how you can find these. Now it's March 7th. Oh yeah, let's go way over here. 36.96. It was on November 29th. We're going to round it up to 37, which is going to tell us the 6th of January. So we come over here, and then we see here is the 6th. So you can see here's 5th and 6th. And if you want to watch the little box there, it'll tell you it had a high of 42.52 and 42.27 on the 6th, and boom, it dropped a complete dollar and kept going. So it did. So in each example, it nailed it perfectly. The last one that we're going to do is 12.12. That's the high. Let me kind of bring this up a little bit. Now that's the high. So you see that? That's 12. There we go. 12.12. And then 12.12, we take the price, it's the high. 44, so we're going to make that a 45. And that converts to January 27th. And then we take it over here. There's January 26th. There's 27th. And then it just drops all the way down to this. So that was pretty big move. And as you can see, most of these moves happen. Big changes in the trend happen within a week. So if you're doing options, you can do very short-term options. And the other good news is you can do calls and puts. Why that is so important is that calls, even though calls and puts has the highest risk, but it has the highest reward. So now, as I mentioned, there's the squaring the daily price, daily chart, and also squaring the weeklies. So let's take a look at a couple of weeklies and see how we do with those. Look at weeklies. So we're going to do the same exact example, except it's now the week. There's our price of 21.86, the low. Now 21.86, we're going to round it up to 22. Now I want you to notice it's going to come up very small here, but it's going to count the bars for me. So I'm just going to left click, and then there you go. Hopefully you can see that. So there's 1 period, 2 periods. Now I'm going to go all the way out. I think we said 22, right? So here we go, 24, 23, 22. So here we go. Dropped, came up, and then continue to go down. Now, what we're going to do is we're going to go to the next high, which is 28. 28? Okay, we're going to make that 29. Click. And then we're going to go weekly to 20, 28, 29. Now this one we missed it by 1 as it went up there. Now we're going to do the one, here we go. This is the one we did on 08 towards 3708. Here we go. 3708, so now we can go out 37. And 36, 37. Here we go. As you can see, next one, drop, 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 drop. So again, this works for dailies and it also works on the weekly option. Now, what happens is if it's happened on a Friday. Okay, and so basically, that's it with the market timing. There's a couple other things we're going to do, but I'm going to save that for our crude oil and gold. So the next market timing that we're going to do, we're going to kind of introduce two more methods, and we're going to and basically what we're going to do is show you how all these methods together is how Gann, William W. Gann, was able to make so many trades on one particular stock or futures contract a month on those, you know, on one particular stock, one particular futures. And it was these different patterns or these different strategies when you overlay them